Next question, Mr. Toby. I've put up some lackluster results since the beginning of May. There have been some bright spots, but I'm definitely not crushing it. That said, my max drawdown hasn't been much better this month than last in spite of better process. In a period of stagnant poor profitability, what are some good things to look at to determine how much of the situation is attributable to doing a poor job as a trader versus a phase where overall conditions just aren't conducive to your edge? Let me reread a section here to get to the main question. What are some good things to look at to determine? So, in order to determine whether it's your fault or poor conditions, you have to know what quality conditions are for your profitability or not. You have to have kind of gone through this a few times where it's not your fault and it is the market shifting. You have to have that experience. Otherwise, there's simply no way to know. So that's the very, very first thing. Once you know that, you know that, obviously, if we were to look at, like this graph that you've probably seen me draw, let me change the share. The profitability curve, where y-axis is, it doesn't matter, win percent, and x-axis, or the other axis, like I said, doesn't matter, is your average winner as a ratio to your average loser. Okay, so this line that I drew, the curved line, is break even. Anything above the line or to the right of the line, so to speak, is profitable. Anything to the left or below is losing over whatever periodicity you're measuring that data point. So, a break even point for a 50% win percent is going to be 1-to-1 ratio. Okay. So, with that said, I have found it very helpful to monitor what my general performance looks like in terms of win percent and risk reward. Let's say my first 30 trades, I'm losing, I'm here. My next 30 trades, I'm winning, I'm here. My next 30 trades, I'm even better, right? We can connect these over time. My next 30 trades, I'm less profitable than I was, but still profitable. Next 30 trades, I lost over. Next 30 trades, I lost over. Next 30 trades, I was profitable. Next 30 trades was a home run. Next 30 trades was something more back in normal land. Okay. And so you start to get this thing, right? Including the phases of losing. And once you start to establish that, and I know this is a little off topic, but I still think it's helpful, you could start to say, well, here is this area that I live in, you might even make it a little smaller, right? You might make it this area. And the only time to really be concerned, or let me take that back, the times where you really want to pay attention and understand that something has changed and figure out if it's you or the market. So, again, I'm a little off topic from your question, is when you see a deviation outside the box here, a deviation outside the box there. Obviously, on a different note, if you're seeing a deviation out this way or a deviation out this way, you might pay attention to that. It might be obvious, right? Volatility picked up is typically a time where intraday traders perform better, or they should, at least in my opinion. I genuinely believe that. This goes for everyone on the call here. If you're trading, of some form of momentum, I don't care if it's like a mean reversion trade. I don't care if the market's doing this. When you take this trade, reverting it back towards VWAP or wherever, you're trading momentum because you're waiting for that shift and you're getting involved and you're expecting momentum to carry that trade into your favor. That may not look like momentum on the next higher time frame, but it's all relative. There's so many different ways to categorize what's going on. So anyways, I think 99% of intraday traders are momentum type traders. And so when volatility spikes, we should make more money. Um, so this is really good to monitor and get your own kind of profile, and start to understand what that looks like and where that's deviating. What, let's say you are here or here, right? Things aren't doing well, like you're saying, lackluster performance, for almost 2 months. I think you want to refer back to your day to day work, your week to week work, your month end work to month end work. A lot of time there's ego in the way. It blinds us to where we are not firm on our edge, our process, what we're doing, and we're kind of stumbling around in the dark. So I think psychology is one place that we can turn and look at your journal. Look at just how much performance has been hurt by repetitive errors, by mental framework mistakes, which lead to what we would define as an error trade. So I think error trades are a big deal. I don't like to always focus on errors, but if we're underperforming, how much of it, again, how much of it is due to my own fault versus the markets? So if you can, number one, like I started to talk off, if you can understand what conditions your methodology performs best in and worst in, well, now you pretty much have your answer off the bat. But it takes experience of trading well and mostly executing pretty flawlessly before you can ever learn that. But that's the first step, to go through a couple cycles of that. And then it's a simple answer. Okay, I typically don't perform well when the S&P has an average range intraday of 11 handles or less, right? Or I typically perform at my very best when the S&P has a RTH range of 11 handles or less. So look at relationships, and I'm not saying go all nerded out and get like p values here. I'm saying look for the low hanging fruit in terms of understanding causality in terms of market relationships. Look at product specific stuff. Are you trading one thing well and losing money in something else? Look at consistency of risk. Are you able to control your risk effectively? Are you able to have a consistent R value if that's something you're going after, or are you getting too loose with your risk and things, getting out of whack there? Find what's off. Is it, if we go down to these basic stats here, if you're falling off your typical pattern, if you're falling out lefterly towards the left, well, then what's the problem here? Well, the way we have this chart structured, it's a risk reward problem. Okay. From there, you need to dive in and you need to figure out, is that from lackluster trade ideas where the risk reward is just not in my favor? Or is it from trade management not actualizing the risk reward that is on the table? If you're drifting out to the right, or excuse me, the right is good. I'm sorry. If you're drifting out down, I shouldn't have drawn that. What's the problem? It's win percent. That 9 times out of 10 comes down to selectivity, right? Are you getting involved in areas where it makes sense to put the risk on? Or are you getting involved in the middle of prior value, the middle of DVA, these trade locations that are not actually that good? Therefore, you're subject to more whipsaws and stop outs and randomness than you would if you were trading from some ideal trade locations. You find yourself again coming back to where it's your fault and you're chasing because you didn't get the trade location you wanted. You got to identify those errors and you got to figure out, how much are these errors costing me in terms of my bottom line, or is it overall conditions? So I know that's a lot of stuff there, but I mean, there's a lot of possibilities when trading is not going well. There's a lot of possibilities. My general advice, which I know you've heard before, but I'll say it for everyone here, is get back to basics. Whatever you feel that your core competency is, get rid of more charts, get rid of more variables, hone in on something that you know has edge and something that you can execute well, and just start simple and start putting up some good performance with that. Um, Feel free to cheat the system a little bit and book a couple green days. I am not against trading your P&L a little bit for pretty much two purposes. Number one, maybe in a tryout setting or something like that, where you say, you know what, I'm going to book a lot of green days. I'm going to walk away. I'm not going to keep pressing because I do have to trade a minimum number of days, and they need to be good and they need to be profitable. So I'm not going to go for home runs here and keep pressing, or I'm either going to have a really tight, give back or whatever. So that's one situation. Another situation is when you are kind of down in the dumps and when you're underperforming, you feel like maybe your psychological capital is drained or whatever. Um, Book a few green days. Who cares, right? You don't have to maximize P&L all the time. There's a human element to trading. There is a financial element to your equity curve that you can actually manage a little bit at times, and obviously psychology and things like that. Um, one thing, this might also sound crazy. I give some kind of like a little bit different advice when it comes to drawdowns and things like that sometimes. Another thing is this mentality of I refuse to lose money. As I come in, I know that sounds crazy and against everything that I say. Don't focus on the P&L, focus on the process. If you've got a setup, you should take it. Doesn't matter if you're up, down, whatever, right? But during periods where you're really down in the dumps, I have found it helpful to say, I think it works for me because I'm a little more liberal with risk. So I need to come in and have a mindset around I'm not going to be flippant with putting risk on, right? I'm going to be very selective. I'm going to not say, well, let me give this a little more room, right? I'm not going to do anything like that. I'm not going to allow myself to really start to dig a hole for the session as I might do if I was really trading well and very, very confident. I'm going to be a little looser with stuff like that. I'm going to give myself a few more flexibilities and freedoms. So, what I'm really saying is, I'm not going to allow myself to do that. I'm not going to like dig a frivolous P&L hole. I'm going to come in and I'm going to be rock solid and I'm going to book profits a little quicker. I'm going to put up green. And I know that probably won't work for everybody. That's probably bad advice for some people, but I'm just sharing what are some little things that have worked for me. Um, you might be in a bad place in this whole scheme of things here. You might be living on a paper thin edge where you are at a 27% win percent, you know, um, you might be living right here. Your profile might look like this with some profitable periods, and you mostly are down here in some profitable periods. You might find out this is a tough way to live. It's a tough system. A lot of drawdowns, a lot of periods of underperformance, if you will, by rate of return standards, not by your system standards, because this is your system standards. So you might be living over here. You might be living over here, right? Find ways of making tweaks and whatnot, adjustments to bring yourself into a safer place away from that edge and find out, okay, do I really need average 8-to-1 risk reward and to take all those opportunities and lose on all those opportunities and be at 15% win percent? Do I really need to be right 80% of the time and have a 0.25 sized average win compared to my average loss? Those are difficult places to live. I find that the safest place is to find a box somewhere here in the middle where you're around that like 40 to 60%, where you're around that, 2 to 1 or better when you're kind of profitable. So that's advice as well. Um, so yeah, a lot of stuff there to think about and look at. And